Hey, it's Ryan from the Option Income Advisor, and today we're going to talk about what to do with your Apple position. It's a stock that I've been getting a lot of questions about, just kind of given the run it's had just recently, over the last 12 months as we've come out of the pandemic. And so, this is a stock that people say you should hold and not trade. But, I think there's ways to trade around your core position, while still owning the stock. Ways to generate, income, if you feel like the stock has maybe limited upside, over a short period of time. And you can do that, with options. And, in the past, we've actually sold puts on the stock. And, I think that will be in play soon. As we get a pullback, you always want to sell puts into weakness. But I think even right now at current levels, based on where the options are priced, it doesn't make a ton of sense to sell puts right now. So this is a video where I'm going to highlight some levels where I think Apple could pull back, some reasons why. I think it maybe kind of trading at a level that it's going to be hard to continue to move higher from here. We're going to look at some earnings growth rates and valuation ratios and things like that I think could be a headwind for the stock just over the next call it six to 12 months. So kind of where do we go from here, and how do we trade around that position to kind of mitigate maybe some of the downside while still potentially holding on to the stock for the long term. So that's what we're going to talk about today. I think maybe we should start by just looking at the chart, because the chart is kind of gives you a good idea of where the stock has been and where we could potentially pull back to, and I'll get to some of the reasonings behind that. But you can see this is kind of post-pandemic sell-off. So this does not include, and I can go out a little bit. You can see that there was a 31% pullback, during March of 2020 at the initial point of the pandemic, and so not really counting that. So as the companies come out of that kind of trough from the initial sell-off, you can see it's had. And this has been historical with Apple. This stock has not been immune to big pullbacks, and it typically has several 10 to 20% pullbacks every year, and so you can see just in the last 12 months, since we've come out of that trough, we've had 4 different pullbacks of 9% or more. So back in September of 2020, we had a 20% pullback. And then kind of later in October of 2020, we had another 12.6% pullback, and then the stock kind of rallied, up into the 140s. We had a 19% pullback, and that was earlier this year. So this was driven off of, we've talked about just the interest rate kind of scare as interest rates are rising. A lot of these growth tech stocks were selling off quite a bit. And then just even recently in April and May, the stock sold off another 9% before kind of breaking out and heading higher. And so that's kind of where we are and where we've been. And so, the point is that, Apple does have kind of significant pullbacks, throughout the year. And I think what we've seen is a valuation expansion, with Apple itself. So if you look at the PE ratio, kind of on a forward basis, which we tend to do with some of these growth tech stocks. You look at the the forward earnings. This stock has certainly pulled back, or not pulled back, but has kind of seen the multiples expand as the stock has risen, because earnings aren't rising as quickly as. And I'll pull this chart up. So this is the forward PE ratio. So earnings haven't been growing as fast as the stock is going up. So what you've seen is a surging kind of forward PE ratio, and some of it has rightly so. It's a stock that I think probably deserves a healthy PE ratio, just given the stability of their earnings and the consistency of their cash flow. However, you kind of get to a point to where, has the multiple expanded too much based on, the projected growth rates. And so one metric that we've mentioned before, but this is something that you need to take a look at now, because Apple's earnings are slowing significantly. So we had a big surge in earnings during kind of post-pandemic, as a lot of individuals and companies were upgrading their technology, and so Apple really benefited significantly from that. And so you kind of had a surge in earnings, but the growth rate now for the next couple of years is expected to be pretty low, kind of in the 4 to 5% range. So when you look at a multiple like this, that's kind of been rising as Apple's has, it's right around 28 times forward earnings. The question is, how much are you paying for the growth, the future growth, right? And there's something called the PEG ratio, which is the PE, price to earnings to growth ratio. So you kind of take that metric of, here's the chart here, and you can see how the PEG ratio has surged. So it's basically the PE ratio over the company's forward earnings growth rate, right? And so you can see how, this has surged up into the kind of 5.5 times range. And so that's essentially saying you're paying 5.5 times the company's future growth rate of 5%. And so, the PEG ratio tends to, it's kind of a valuation metric you can look at to kind of see how much you're paying for future earnings. And, the kind of rule of thumb is kind of in that 1 to 2 range is probably appropriate for like a growth company. And so if a company's growing at, 25% a year, you could in theory sustain a, 40 to 50 times multiple on the stock and not be too overvalued. I mean, obviously, if you could get a PEG ratio under 1, that would be considered undervalued. So you look at Apple's at 5.5. It's kind of concerning, given that the growth is slowing, but the stock has continued to go up. And so, I would say that that's probably a point at which, the stock may be, kind of peaking for the short term until maybe earnings growth can kind of catch up, and maybe the valuation multiple comes down a little bit, so that it's kind of in a more appropriate range. And so let's take a look at the stock profile again, and then we'll go back to the chart and look at those levels. I was talking about of where the stock could potentially pull back. And so here's what I was kind of talking about with the earnings surge. So you can see the big surge in 2021. So again, this is fiscal 2021, which their fiscal year ends in September each year. So this is basically this year, 2021. And so you can see the big surge here, up to about $5.5 per share, and then you can see the sales have risen to about 365 billion. It's a pretty high level, 365 billion. But you kind of get to this law of large numbers problem, right? Where at $2.6 trillion of market cap, Apple's can't really continue to grow at 20% a year. It's just not possible, right? You can't grow, a company that's $2.6 trillion at that high of a growth rate forever, right? So at some point, the growth rates have to come down, which they are, and you can see if you look at the consensus estimates for 2022 and 2023, you're basically looking at flat earnings growth and flat sales growth, right? They're projected between kind of 1% and 4%, both on top and bottom line, but that's historically, I mean, that's a pretty big change from Apple's growth trajectory, and I think they're kind of hitting just that point, with their business again at $2.6 trillion of market cap. Again, this company is going to be a stable growth stock going forward, but the growth rates just aren't going to be as high. So how much are you willing to pay for, I guess, the stability of the cash flows, right? Again, as I said, I think that warrants a higher multiple, on a reasonable, scenario, but at some point it gets capped in how much you would be willing to pay for a company that's only growing at 4 or 5%, right? And so that's kind of the analysis that you kind of need to look at, and we're kind of there, at that point where the stock has gone up quite a bit, the multiple has expanded, and you kind of got to look at it now and say, is it time for a pause? And as we get to a point to just the stock to consolidate a little bit again, and there's probably a better entry point. I certainly wouldn't be buying Apple at this price. So the question is, what can we do with our Apple shares? Do you sell them outright? You take a little profit, possibly, but one strategy we love using, with stocks that we own are covered calls, right? So, selling covered calls into this strength, I think makes a lot of sense, knowing, that the stock could potentially be pulling back, and kind of how stretched maybe the valuation multiple is, especially compared to growth. So, how kind of stretched the PEG ratio is for this stock in particular. And so, we'll be looking at October again. That's kind of our sweet spot from a timing standpoint right now. So we're looking at these October 15th call options to sell. And so what we look at with call options, kind of similar to put options, is that we look at the average monthly yield, and then for call options we look at the upside profit. So how much upside profit do we have left between the premium we're getting on the stock, and then how much the stock can rise over the current price to our strike price of the call before we'd have to sell it, and then what would our total profit be. So looking at some of these metrics here, again, I would try to target 1% or more if you can on these calls, and kind of see where you can get from an upside profit standpoint. So again, the stock's trading at 156, 157 right now, as it's kind of continued to surge. So you could sell the 165. Again, this is just over a month, a little over a month out, and you can get about $2 a share for these calls. So you can sell these calls for about $2 a share. So in essence, you're really selling the stock for 165 plus your premium, so about $167 a share. So the question you need to, or the analysis you kind of need to do is, would I be willing to sell this stock at 167 roughly over the next 38 days, or do I outright want to sell the stock today? Right? I would say you might as well hold it. Collect some premium, again, about $2 per share. And what that does is it doesn't give you a huge mitigant to the downside, because again, the stock could easily pull back 10 to 15% from here. But there's also tax implications with selling a stock that maybe you have large capital gains on. So this is a way to, again, potentially earn some income while you kind of see this stock trading around like it historically has, where you get these pullbacks. And then over time, the stock, should continue to rise higher. But again, you have to have the, you have to have the right mindset of, realistic mindset of where this stock could actually continue to grow to in the future, right? It's not going to be a 20% grower most likely, over the next 5 years. It just, the law of large numbers says that's not, it's probably not possible, right? So it's experienced over the last 5 years about a 42% compound annual growth rate, right? Which is how the stock has surged up to 2.6 trillion of market cap. But again, that really can't happen going forward. And so I think what this stock should probably do is up its dividend and really kind of return some of that money to shareholders, all that cash they're sitting on. Because really it's become a very stable, probably dividend growth stock, if you will, right? If it had a nice high dividend yield. And then on top of that, maybe you could write, covered calls. I mean, this could be a phenomenal, just income investment, stable income investment over time. And I think you'd probably see less volatility in the shares if they did that. Obviously, we're not there yet, but that's the type of stock I think it's kind of turning into. And it'll be a great one to hold, for the long term. So that's the analysis that we need to consider right now. I think it's a great way to, again, keep your long term position. If you want to trim a little bit at these levels, I think it's just fine. But why not use the covered call to potentially trim some of the stock at maybe a little bit higher level if it continues to run through the end of the year. And again, this is only a short term 38-day trade. If you can collect your $2, stock just sits here. You can rinse and repeat and do that again pretty much every month, and collect an extra 12% in premium over the next 12 months if you can continue to rinse and repeat at that level. Which again, when you combine multiple covered calls on a stock, it really does help mitigate some of that downside if you were able to, or if the stock was going to pull back, say 10 to 20%. And so that's our strategy. I think the 165 looks pretty good, but I would be willing to even let some go at 160 or even 170. So you can also, if you have a large enough position, you can write different strike levels within the same months. If you have 200 shares, for example, right, you could write one of the 160s, one contract to the 160s, and then one contract to the 165s to maybe again kind of just diversify that sale price a little bit. So let's go back to the chart just quickly to kind of end things, and you can see where what would a 10 to 20% pullback look like for Apple from current levels. And so you're kind of in that 125 to 141 range. So if you did want to pick up some shares, I would almost wait again through cash secured puts, which I think would be a great strategy going forward, but not at current levels, because the options aren't priced high enough to get you a decent premium down here in this range, which again I think is probably the target range for the stock. And so as the stock starts selling off, so if we come down to say 150, 145, I think that's where it makes a lot of sense to to potentially sell a cash secured put at that point, because I think you'll be able to get a nice premium. And if you can get it in this 125 to 130 range, I think that would be appropriate for this stock right now. So that's kind of how I would play potentially selling cash secured puts in the future as well. Wait for a pullback again to kind of the 145 range, and then sell cash secured puts. But in the meantime, selling covered calls I think makes a lot of sense in the short term. So that's our trade for Apple. Again, it's a stock you can hold, but I think this is a great way to trade around your position and just generate income on a stock that you think might not have a bunch of upside in the short term. So that's the trade. Let me know if you have any questions. Take care.